So we spent a lot of time looking into AI risk because our concern was, well, what if DeFi is uninvestable now? Because Claude and Mythos and Fable can just destroy everything. And what our research has shown is that all the hacks, or 99% of hacks that actually happened, wasn't AI finding a way to break a smart contract. It is AI finding legacy OPSEC vulnerabilities and exploiting them. And the metaphor I kind of use is, imagine you have a bank which has a security up to standard. So AI doesn't invent an amazing drill that breaks through a metal vault. What AI does, it finds 100 old banks with wooden doors that you can knock out with a kick.
Welcome, everybody. Welcome to another 1000X show. We are actually recording at the Out East Summit hosted by The Tie. We're super happy to be here because we have an amazing guest and a good lineup today. We're in a beautiful vineyard. Welcome, Evgeny.
Pleasure to be here.
Welcome to the podcast. I want to start by saying you are one of the few market neutral funds really left in crypto that are actually managing substantial capital. And maybe tell us a little bit about yourself first. How did you even get into this industry?
Yeah, we do carry the flag on the market neutral side. And yeah, I launched Re7 5 years ago. We started as a market neutral fund, and that was kind of inspired by my experience in TradFi. I spent 10 years working in that world, at first in a hedge fund doing equity long short, and then UBS and Deutsche on the portfolio management side.
So tell me a little bit about what it was like to be on an equity long short desk back then. Like, what were some of the things that you were looking at or doing? What were the strategies that you were running?
Well, that was a dream come true. It was a fundamental discretionary strategy covering EM. So we had an opportunity to go into Egypt after Arab Spring. We had an opportunity to go into some unique companies in like small caps in Turkey, shorting Chinese real estate market by shorting iron ore companies in Australia. And I think that kind of inspired me to look for inspiration in unorthodox places because that's where it felt the value really light.
So actually, I want to go into that. You went into Egypt after the apps, physically went into Egypt?
Or just Egyptian stocks.
Okay, you went through Egyptian stocks.
Yeah, so they closed the exchange when Arab Spring started. We've done a lot of work, and then we found there were some listed real estate companies trading at like 30 cents on the dollar, and we did some trades there.
How did you get the information needed to make those bets?
Well, the beautiful thing of working in a large institutional hedge fund in TradFi is that you just get access to people through brokers.
Okay.
Right. So we would call, it was very easy actually looking back. You call a sell side analyst and, you would ask him to line up a few meetings with people who are running those companies. And then back in the day, there were all these CEOs coming to sell side conferences. So then they would fly to London, which is where I was working at the time. And then you go and meet everyone and you have access because you have capital.
When you say back in the day, is that no longer the case? You said CEOs are going to sell side conferences. Now they're not?
Back in the day compared to crypto.
Okay.
Where, it's an anon person on Twitter that you have to find a chance to speak to rather than sitting down with the CEO.
Right.
That's what I meant.
It's a lot harder in crypto to get real actual information out of people.
Legitimate information. It's very easy to have someone in a Telegram group or on Twitter, but actually to have an institutional style conversation, that's much, much less frequent.
But people still, in the traditional world, they still lie to you. I'm reminded of this story by one of my former bosses who used to work at Merrill Lynch, and he was on the commodities trading desk, and they invested in some coal mines in Indonesia, and then 3 years later, it turned out those coal mines didn't exist. And I'm wondering if anything like that, or if you came across anything like that, because if you're going into Egypt, if you're going into, Australia, probably not so much, if you're going into all these different emerging markets, access to information is so important. Like, how do you make sure that what you're getting is real?
Well, you have to vet everything, right? So I think there is no sacred place. There is no safe environment where you can operate, but there is a reason why governance is better in developed markets, is maybe less developed in emerging markets, and it basically doesn't exist in crypto, right? So these are spectrums. So the higher the level of confidence you have in information, the less you have to vet it. And then, the higher the cost of lying is to someone, the more you can rely on it. But yeah, when you operate with EM, you have to bet on the lead information, but ultimately you take a view. Yeah, and I've been in situations where, there would be a CEO of a company and he would walk me through a deck, and then I would ask him a couple questions like, what if this forecast doesn't materialize? And then he would, shut the deck and say, well, then we're done. Right? So like you get to these personal conversations with people like anywhere else.
How do you even respond to that?
I'm like, well, this is very helpful. Thank you. Let me cross this off from my list.
It's like if the CEO throws a temper tantrum, I'm not investing in that company.
That's usually a good sign.
Yeah, okay. That's good. You got to keep your cool. I actually think we could do an entire podcast on like the first part of the conversation. You could probably talk for like 20 minutes about what happened in Egypt if you wanted to.
Yeah.
Like that would be kind of fascinating.
Yeah. I started trading personally, like with tiny amounts when like 2007. So I experienced the whole 2008. And I was inspired by, like, I want to be like a George Soros and like find this like a trade in macro themes. So I spent most of my time looking at that when I was in the fund. And, Chinese kind of real estate captured my imagination. And I was looking into, okay, how do we short it? And you can't really short anything in China, or at least not back in the day, because, it's not a market you can actually do that in. So we were looking for proxies. And I was like, okay, well, what will suffer the most if Chinese real estate starts to suffer? And it's, what goes into building real estate, copper, iron ore, whatever, or steel, but to be more precise. So then you look at the steel, okay, there's coal and there's iron ore. And then we looked into iron ore companies and, I don't remember the numbers exactly, but commodities are extremely cyclical.
Right.
Such like crypto.
Right.
So when you have a commodity that's in deficit, but the marginal buyer is starting to fade away, and these companies have a lot of leverage, you can have a one-way street. So then we shorted some iron ore companies, and that did pretty well.
Yeah.
That was a lot of fun.
That's when you say iron ore, did you have to go into specifically figure out which iron ore companies are selling directly into China? Like when you construct a trade like that,
well, you work backwards, right? It's like a domain that you have to collect on the backwards. Like, okay, what does China need the most? Steel. Okay, great.
Right.
They also need 10 other things. So which one is most vulnerable? Oh, the steel supply chain is most vulnerable. Okay, great. So then within the supply chain, whom do you have? You have people on the smelting side, on the distribution, so on and so forth, and then you have the supplies of raw commodities into that. So then, okay, well, that's an interesting bit. Then you look into coal and like, well, actually, there's nothing clean I can short. So, okay, let's look at iron ore.
Right.
So you just go all the way up to the underlying business, and then you find something that has a very clear correlation. And like, oh, if China real estate is down, then these guys will lose 90% of their net raw profit.
That's so interesting. It's something that I think about a lot these days because of how AI has made research so much easier to do.
Yeah.
Is that back then, I mean, you actually had to really spend a lot of time digging into things and figuring out, okay, well, what are the downstream effects? And I think it's actually distorting the market in some ways today because everyone will now just go on Claude and they'll say, okay, if there's a bottleneck in AI, if there's a bottleneck in data centers, what are the downstream companies that are actually supplying this? Like what's needed to build out a data center? What's needed to fabricate these chips? And you're like easily pulling up these companies. And so like, for example, something like CCOI had a massive ripper because I think actually a bunch of people it popped up super early on Claude and people bought it. And then it actually just did not materialize at all and like sold off 70% because nobody had actually done the real research. And so it's like there's almost both more opportunity and less opportunity in this deep type of downstream research kind of thing. It's kind of, but that's what you've been doing for a while.
I think that's a great point. So we always knew the kind of cool things that are emerging. So a year and a half ago, we rolled out a fully autonomous AI agent kind of venture fund that's tokenized on Base. Whereas like you buy a token, it takes your money and it like goes and makes like venture investments on chain, liquid venture. And through that, we learned a lot about how to use agents for investment research because it's highly experimental. We didn't advertise it. We didn't raise anything for it. We just kind of shipped it. And it's actually done pretty well. But what it told us is that,
what does that mean? Like a fully autonomous agent? Like it's literally making all of it. There's no oversight at all on your part.
Not now. Yeah, it used to be in the beginning, and then like eventually,
who's feeding it the information?
So we built that framework. Like imagine you hiring an analyst today, right? Zero experience. You tell it where to look and how to think, but then once it gets all the information, it decides on its own.
What framework are you using? Are you using Hermes or using like OpenClaw? Like
Hermes. Yeah. Okay. Yeah. And that taught us that you can use agents for a lot of stuff, but actually you can't replace a senior analyst, right? So in our world, you can replace a junior analyst because it can do repeatable tasks, but we don't feel it's to the point where we can actually replace an expert.
Okay.
So I think your point is spot on because yes, it's much easier to do your research right now, but it will also give you a lot of false positives.
A ton.
Because you're like a person who doesn't know what, like, if I start reading about biotech stocks, right, I don't understand the sector, it will give me an answer and I'll think that's the truth. And then if you're a specialist, you can then deduce what Claude is telling me and then you'll find the alpha and the spread. So it's like it's changing the whole game.
This is what people I think miss a lot of times with AI is they kind of just assume that its capabilities are that it will just give you the right answer.
No, it's not.
And it's just not, that's not that at all. I mean, there was this one thing that just went super viral that was called the World Monitor. Some guy rebuilt Palantir's dashboard for monitoring the world, and it went super viral on Twitter. And the first question that you have to ask yourself is, okay, but is the data right? Yeah. Like the entire point of Palantir is that if you pay for their data, if you pay for their monitor, the actual numbers are correct. The actual things that you're looking at are correct.
Exactly.
And there's kind of no way to tell, right? The entire premise of the business is that they've spent billions and billions and billions of dollars on making sure that it's right. They've hired a ton of people. They have on the ground, individuals detailing all this stuff, and you can't just hope and dream that AI is going to do it, which is again why experts I think are still very valuable. But
I agree. People have very short attention spans and they want easy fixes to their problems, so they think one message to Claude will give them an answer, but that's not how it works.
But you can use it effectively, right? So if you collate all the data, you find all the different companies, and then you yourself have at least narrowed the space that you could search. I think that's one of the most valuable, especially in investing, is narrowing the space that you have to search for your answer.
So I think it accelerates your work by a magnitude of a 10x, if not more, but it doesn't replace the need to have you think.
Yes.
And I think that's where people get it wrong because they just stop thinking.
Yeah.
They just ask the question and they take the answer without actually processing the information themselves.
Yeah. So you were in that world for almost a decade, or more than a decade.
About a decade.
About a decade. And then you find your way into crypto. Why did you leave? What drew you out of your seat, which presumably was actually quite interesting and fun?
I was working in a very well-established, investment world, and I was thinking, how do I 1000x, my personal growth? And it became very clear that the hedge fund world and the banking world is, it's too established, it's too restrictive, and especially in London, which I would assume Europe is probably a little bit different, opportunity set-wise. But coming out of the European Greek debt crisis, the opportunities were pretty limited. So I was thinking, well, what is the most realistic way to, meaningfully grow my career and opportunity set whilst doing something that's exciting? And I couldn't find anything in the TradFi world, so I started educating myself on tech, on fintech, and that's how I came across blockchain, because like most people, I would have heard about Bitcoin in probably 2011, 2012, didn't really understand it, didn't click with me. And then seeing blockchain and then, discovering Vitalik and Ethereum in 2015, that was my kind of aha moment coming to the space.
It's actually quite, you had a method to actually approaching this, which I think is very different from a lot of other people, where sometimes when I interview people, or even myself, I think I had more of your approach where I was looking for edge. A lot of people just sort of fell in love with crypto. It seems like you were searching for an opportunity. So can you walk me through that process? How did you approach searching for that opportunity?
Yeah, I was trying to be systematic because I'm always hopeful, to fall in love with something, but it never happens. Or it never happened, and therefore you have to make it happen for you, right?
Right.
So I was thinking, what is the thing I know nothing about, but it's very important? That was tech, because I come from a very traditional economics and finance background. So I, convinced my boss to pay for me to do a course at Stanford. As I did that, I was like, okay, now I kind of understand tech, I kind of understand finance. So I started looking into fintech, and I was like, okay, I want to learn. What's the fastest way to learn is to lose money. What's the best way to lose money is to be an angel investor.
Yeah.
So I made a few angel investments in the fintech world, and through that I discovered blockchain.
Okay.
And I was like, okay, this is the whole crypto thing. It feels very scary, lots of negative articles about it. Maybe it's a scam. So I made the decision to not make any investments for the first year. And I decided to allocate 2 evenings a week to go to meetups and lectures and seminars. By the virtue of doing that, I attended 100 events over the course of the year. And
you're a busy guy. 100 events over the course of the year. Yeah.
Well, that's actually, if you think about it, 2 nights a week is not that much.
Yeah.
It's all about consistency. And I think it's all about you really wanting to get something out of that. And then through that, I was lucky enough to attend a meetup where Vitalik was speaking. And, that one meetup was my gateway into this.
And what year was this? When did that happen?
2015.
2015. Okay. And so you hear Vitalik speak and you decide to yourself, screw EM, screw TradFi, let me get in. What was the first step that you took?
The first step was trying, because, I attended a lecture where Vitalik was speaking, and I didn't understand anything he was saying. But it was very clear, this is the future, and this is kind of the beautiful mind that's building that future. So I just went very deep into the Ethereum world, and then I started proactively building a network, meeting people, and then doing research on the space, and then eventually ended up investing personally.
Okay. But now a lot of people, I think, when they get into crypto, they start off by just directionally investing. Maybe you buy some Ethereum, you buy some Bitcoin, you buy this. What you do now is you run systematic strategies to take advantage of the cryptocurrency markets and all the inefficiencies that exist. So when did that start happening? When did you start building strategies to trade crypto?
When DeFi went live. So most people do come and buy coins, but most people don't have a system, they don't have a framework, right? They buy because a friend tells them, but if you buy something, you don't learn anything, right? So you need to choose what you want to learn. And if when you're starting to learn, you want to understand if you can have a method and a sustainable process, because it's one thing to trade on the weekend. It's another thing to build a business, go out to people to raise capital, and then hire people whom you're responsible for. So when I saw DeFi, that was my second aha moment, because prior to that, it was very exciting to invest in venture, to invest on the liquid side. But this was basically buying a story and buying a promise of the future and the promise of brighter tomorrow, because there was nothing fundamental, right? There was, let's build this network and then maybe people will come and use it. Let's build, an Uber on chain. Let's build Nvidia on chain. Let's build this and that. But there was nothing fundamental. When DeFi started in 2019, it became very clear that for the first time in the history of crypto, we had real decentralized apps which you could use, and they would monetize that, right? They would charge you a fee in some shape or form. And when you have an app that charges you a fee, whether it's on App Store or on Ethereum, it now is a real business, because you can value it and you can measure it and you can monitor it. And that gave me confidence to dive into that basically full time and build a career around it, because that was an ecosystem where you could make liquid investments with a framework and you can earn yield with a framework.
I think DeFi yield has taken on a little bit of a negative connotation these days, because when you look back at 2021, there was DeFi yield were effectively these companies that were issuing tokens to people for usage of the platform and basically paying far too much for customer acquisition. And so yield back then meant parking your capital in some pool, using an application, and then just getting paid out by DeFi protocols for doing that. When you talk about yields, I can't imagine that's what you're still doing. You must be talking about something slightly different, or is that still the world of DeFi today?
So I think that's a great question, because it comes down to a framework, right? So to me, DeFi yield is something very simple, where I would speak to you and I would suggest that there's an opportunity for you to invest $1 of your capital, right? And then you'd ask me, okay, that's great. What is the risk that I'm taking? So as long as I'm delivering you a strategy where you only take smart contract risk, the risk of a DeFi platform collapsing from a software failure rather than the market failure, that's what I classify as DeFi yield. And then there's the source of that yield, right? Is it what you said, which is basically companies using their quasi-equity as a marketing budget? It's like, hey, open an account with me, I'll give you a piece of my business, which they did with tokens. That also obviously is dead, because the token market is dead. But there are other things you can be doing within the space where you're getting paid by the virtue of being an operator in that platform or in that ecosystem. And we have a whole framework that we've developed around that.
Right. And so can you talk to us about maybe a specific type of strategy that you're running right now that illustrates what that looks like concretely? Because I think sometimes it's hard to wrap your head around, okay, if I have this dollar, what am I going to actually do with this dollar?
Yep. So it's actually, DeFi is way overcomplicated for what it is. These are all very, very simple concepts, right? What do you get paid for? You get paid when you process someone's trade, right? So you put money into Uniswap pool, you take, one stable coin, another stable coin, and then you collect a fee. And then maybe that yield is attractive to you or maybe not. So if it's not, you go further. Then you can lend, right? And you can lend your stable coins against coins, which are very volatile and very risky, or less volatile and less risky. More recently, you can be lending against RWAs, basically tokenized credit, which is great because we're basically back to what TradFi is. But the thing that's been most exciting more recently is tokenized stocks on chain, because your yield, or at least our yield, is an expression and a derivative of the market environment. When it's a bear market, there is less appetite to trade, there's less appetite to lever up, and therefore, if you're an economic agent that benefits from servicing the ecosystem from a liquidity standpoint, you make less. When there's a bull market somewhere, you get paid much more because people are willing to pay more for leverage, they're willing to trade more, so on and so forth. And there's a bull market in AI stocks right now. So the same things we used to be doing with meme coins or other assets, being fully market neutral, we're doing with tokenized Nvidia and other assets like that.
And so why is there a spread between whatever yield you can get doing this in the traditional markets and the yield that you could get in crypto? I think that's a big question a lot of people ask, is there's a yield in crypto specifically because there's a higher risk associated with that. And so what you're just getting compensated for is they're getting compensated for the risk that Claude Mythos comes in and breaks one of these platforms. They get compensated for the fact that whoever you're lending to is actually a much higher risk of default just by virtue of being in crypto. And so maybe talk about that.
So there are probably two answers to this question. On the AI side, I can address this in the second half, but I think people fundamentally misunderstand where the yield comes from, right? The yield doesn't come from someone coming to you and saying, hey, this is a risky platform, therefore you get paid. You actually get paid for being a lender. You get paid for acting as a market maker. So these are the roles that in the traditional world belong to prime brokers, banks, and the citadels of this world. In this world, they're outsourced. So my inspiration to start the firm wasn't that I was excited about the specific strategy. It was a thesis that DeFi is only different from TradFi for one reason, and that is the role of a platform is separated from a role of a liquidity provider. So if you have a bank in the traditional world, you walk into a building, so it's in like a physical interface, you talk to someone, the bank matches borrowers and lenders, and the bank has its own capital. You would think of Uniswap, it has an interface, and it matches buyers and sellers, but it has no capital. So the role of a capital provider is outsourced to the market, to an individual market participant or to professional market participant. So we do what banks do in the real world. We provide liquidity to the ecosystem, and what a JP Morgan is earning because someone is trading or levering up on Nvidia with them, we're doing that on chain. So we're not getting paid because DeFi is risky. We're getting paid because there is economic activity on chain, and then we're the ones making it happen.
And so as crypto and traditional finance sort of converge, I assume that you're going to have to become competitive again. Do you think that JP Morgan is going to come in here and start doing these things? Do you think that other firms are you already seeing that? Is edge already eroding?
So that's a great question. And when it comes to the source of my yield, I would separate it into two categories. One is the crypto native yield, where a DeFi platform comes to me and says, hey, please lend stablecoins against BTC. And I'm going to pay you a lot of money because we're new and very risky. So then we're explicitly taking a crypto risk. And then we need to think whether AI can break that platform.
Right.
And that's not something we're competing against at JP Morgan, right? If someone wants to borrow against tokenized Nvidia, we're explicitly competing with the traditional world. And these worlds are converging and colliding very, very quickly. We're speaking to banks who are looking to lend stablecoins into some of the vaults that we're running. We're looking for people to tokenize their equity or their credit and put it into the DeFi vaults that we're managing. We're looking for people who come to us and they want to take a loan on the back of a real world position they have with a reinsurance or a credit investment.
Can you explain the concept of a vault to people? When you talk about DeFi vaults, I assume that half of our audience is familiar with it, but there's a probably substantial amount of people out there going, what are you talking about? Like, what is a DeFi vault? And not only that, why are DeFi vaults useful?
It's a great question. It goes back to my kind of assumption and the thesis that DeFi terminology is just terrible. A word vault doesn't mean anything.
People just randomly came up with the word DeFi one day too. And
that's very true.
It just stuck. And now we have to contend with that.
And now we have to explain to normal people.
Yeah,
exactly.
Like what does
so a vault is basically, it's an investment box.
Yeah.
Right. Inside that box, you can put a meme coin. So I can say, I have a vault that will buy a meme coin for you. And you're like, well, great. Thank you very much. Or I can have a vault, which is running hedge fund strategy. Right. So just like a word fund doesn't mean anything. You need to understand what the fund actually does. The same goes for the vault. So you can think of it as an automated financial activity, which sometimes is all about finding a trading strategy edge. Sometimes is basically running a lending book. So it's acting as a risk manager in the bank where you're deciding, am I giving out the mortgage to person A or person B?
I guess the obvious follow-up question there is, but what makes that more useful than just a fund, right? Why is that a better product to offer people?
It's not that I wouldn't think of it as a better product. It's a technical evolution of what the product looks like. So for example, 30 years ago, if you wanted to invest into a fund, you would have to fill in a form. More recently, you can call your banker and they will buy the fund digitally for you. Or you can buy an ETF because it's much cheaper to launch ETFs these days. So it's simply a different wrapper. It doesn't make it better or worse because you can have an amazing fund which is extremely clunky and you can have a terrible vault or vice versa. So it makes things more accessible. It makes them easier and more transparent. But these are the features that can't really make a strategy better. They just make explaining and selling that strategy better.
That makes sense. And so the types of people that are interested in investing, so you run DeFi vaults, you run individual strategies. And one question is, who is actually putting money to work here, right? You ran over $1 billion. Whose money is that? Who's coming in? Who's interested? Is the market growing or is the market shrinking?
So in terms of who these people are, it's a broad mix. When it comes, for example, to our fund, to our funds, like we've been approved by several very large global investment banks to be put on our platform. So we have banks and clients of those banks. We have foundations, endowments, fund of funds, professional investors. When it comes to DeFi Vault market participants, most of them are on-chain users. Well, not most, all of them are on-chain users. And some of them are large crypto holders like DAOs or whales, or just individual people depositing into vaults. And in terms of capital going one way or another, so our business has grown quite meaningfully over the last 5 years, even though the space hasn't really grown that much. But more recently, we've seen...
And why do you think that is?
Why
have you grown when other people haven't? What are you doing differently?
I think just surviving. I think, I ask myself that every day.
Yeah.
And if someone was early to DeFi, they could have become early to DeFi if they were early to crypto, right? And then most people who were early to crypto were reasonably young and who started playing with it without a very clear strategy. It's quite rare, I think, for someone to have spent 10 years in TradFi and then go into DeFi. So we have a 5-year track in our flagship DeFi yield fund, so going back to the early days of DeFi summer. And what gave us the confidence to launch it was the fact that we were in DeFi since day one.
Right.
And then what also gave us confidence is that we've been able to develop a risk framework around DeFi, because you're right, people don't understand it and they're very anxious about it. But when you actually develop a whole risk framework, then it's not rocket science and you can make it work. But not everyone was following a risk framework. Lots of people were looking at me like I was an idiot when I wasn't getting 20% yields in Anchor back in the day.
Right.
And some of those people are no longer around. So yeah, I wish someone would tell me the secret sauce, but
it's just sticking around.
It's just showing up and executing.
You were running a fund during the collapse of Luna. I mean, that was probably a very interesting time for you to market your fund. Did you ever have any exposure to them? You never did.
Yeah, so we looked into Anchor and it just didn't pass our DD. So we red flagged it and we have never had a single cent in it.
Right. Do you see any corollaries between what Michael Saylor is doing and what happened with Luna with Stretch?
Not really. Not at all, actually, because Luna was that backed by equity, and that equity was worth nothing because it wasn't doing anything. Here we have basically like a Lombard loan, right?
Right.
He's holding an asset that's worth $100, and he's borrowed, I don't remember the latest numbers, but let's say 30. So could this be, Bitcoin goes down by 90%. Could then he be forced to sell and then pushing the price down further? Yes, of course. But at the current levels of leverage, it doesn't feel like it's a risky thing.
Do you foresee yourself getting more involved in traditional markets now that, people are talking about the fact that crypto is really, the economic activity is sort of taking a hit. We're in a slow period of the market, and the equity markets are actually trading in ways that they've never really traded before. There's so much activity happening there. Do you ever look over and say, hey, there's some strategies that we run that we could probably do in the traditional markets as well?
There is always a temptation to go beyond your core area of expertise. So far, we've said no to that because we've built a very considerable kind of superior edge around DeFi risk management, and that's our core expertise. When I think of myself going to our investors or potential new investors and telling them that I can trade Apple better than, Citadel or Source, I don't think I can do that. As these worlds converge, though, there's going to be more opportunities for kind of the DeFi native lenders and market makers and traders. And that's where we can benefit from that, because we can structure those, we can find spreads, we can find arbitrage, but we have to do it on chain, which is where our strength lies. But also we take a different view on the crypto economy itself, where we think actually it's likely to accelerate, as in we're more bullish the market rather than bearish.
Right.
And that's why we want to stick to our guns.
Do you guys do any market making on platforms like Liquid or like Hyperliquid or Lighter?
Some, yeah.
Some. So when you talk about DeFi strategies, does that, what right now is interesting to you in DeFi? Is there any, I think a lot of people have sort of taken their foot off the gas. They're not really looking at DeFi anymore. Are there any innovations in the last 6 months, 12 months, 18 months that excite you?
So I think when it comes to what's exciting in DeFi yield right now is everything around tokenized stocks. The spreads you can earn and the trades you can do in a fully market neutral fashion. In terms of new opportunities and DeFi innovation, you get very jaded and very blurred at some point because like you would have seen, 10,000 platforms. The coolest thing we've seen more recently is probably tranching. It's been around as a concept for a long time, but only recently have we seen people starting to execute on it. And that's basically rebuilding traditional finance. So I wouldn't say it's very novel from a financial engineering standpoint, but it's definitely novel to DeFi, and it's useful.
Do you need a really robust tech stack to be able to take advantage of these opportunities? Or are there things out there that your average person could go in and allocate their capital to and earn a good risk-adjusted reward?
I think the hard part is not the tech stack to allocate, it's the ability to risk manage, right? Because you're putting money into a DeFi platform, how do you know it's not going to get hacked, right? What's your framework? And I think it's very hard to do that as an individual because the process is unclear. It's like as an individual, we think of DeFi as high yield loans, right? You have a set of platforms that sometimes collapse. So as long as your yield is higher than your kind of cost of default, then you're okay. But as an average person, like if you show me a couple of bonds issued by companies I've never heard of, how am I expected to spend my Saturday evening, doing my research? You can't really do that.
Right.
So when people go into DeFi, realistically, they go blindly. They go on the back of a brand that they trust and a CEO who is active on Twitter, but they're not really doing their research.
Which sometimes it's good and sometimes it's bad.
Right. My point exactly. So it's pretty dangerous and you need to get lucky, right? You need to get lucky to not get wiped out because once you do, you're gone, right? And you're hoping to earn 10% or 20 or 30, whatever. But if you lose 100%, in the second after you deploy, that's it.
What do you think is a reasonable yield right now in DeFi?
We're getting like 11, 12%, right?
11, 12% consistently. That's pretty solid. And when it comes to actual specific platforms, I'm curious if you have any takes on what platforms are actually in that high yield bucket, in that high grade bucket.
So the way how we operate is we've developed a probabilistic risk rating system for DeFi, and we rank everything as AAA, CCC, and obviously the usual suspects would be in the AAA kind of category, right? This Yoavis.
Are there any things that you specifically look at that might not be obvious to people on how to rank these in terms of safety? What goes into the safety rankings for you?
It's a very long process with dozens and dozens of checkpoints, but I would highlight one specifically that I think is absolutely critical in the context of AI risk, right? So we've seen a record number of hacks in March, April, right? When you actually look at them in terms of dollar value lost, it's very normalized. It's below 2% annualized, but the number of events is very, very high. So we spent a lot of time looking into AI risk because our concern was, what if DeFi is uninvestable now? Because Claude and Mythos and Fable can just destroy everything. And what our research has shown is that all the hacks, or 99% of hacks that actually happened, wasn't AI finding a way to break a smart contract. It is AI finding legacy OPSEC vulnerabilities and exploiting them. So I spent a lot of my time talking to TradFi, and the metaphor I kind of use is, imagine you have a bank which has a security up to standard, a great, metal vault. So AI doesn't invent an amazing drill that breaks through a metal vault. What AI does, it finds 100 old banks with wooden doors that you can knock in with a kick. So we spend a lot of time looking into OPSEC, and that's probably the most critical part right now.
Do you think that we're going to get a ton of upgrades in the future, and at some point this is going to become even more secure? Or, okay, so that's your take, is that we're actually trending towards security, not away from security?
I think that's the trend we're seeing very clearly, because not a single, out of the, let's say, 60 hacks, roughly, that happened this year, we didn't even know 50 of those 60 platforms.
Right.
And if our job is to know every single platform that the sound, and we don't know some platforms, it probably means they're not very large and not very serious.
Makes sense. Evgeny, I think this is a good place to wrap. But thank you so much for coming on to the 1000X podcast. This is a lot of fun, and it's good to have you.
Thank you for having me
on at some point.
My pleasure. Thank you.
Nothing said on the 1000X podcast is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of 1KX Media. Our hosts, guests, and the 1KX team may hold positions in the companies, funds, or projects discussed.